I want to ask you an individual question. Paul, following Trump's re-election, what is your outlook and how do you think tariffs could impact your portfolio?
Yeah, so as I said, I think the fundamentals of the global economy are arguably getting better. Inflation and rate shocks from past central bank hikes are diminishing. We're seeing real incomes growing at a reasonable rate. Credit growth is improving. Housing markets are improving. Labour markets are easing in a relatively orderly way. So it's a reasonably constructive backdrop in terms of that fundamental picture. Numerous risks, as we said. Um, US, I think, does look well positioned. Growth there probably will slow modestly. That should not be problematic. Rates will continue to decline, and the decline in rates will help to cushion the impact of high valuations. I think the premium earnings growth rate of technology in general and the Magnificent Seven cohort in particular against the rest of the market will diminish over the next year, but will remain positive. So the notion of some broadening in markets makes sense to me, but I'm not bearish on big tech. I think portfolios do need balance between that growth aspect and those large leading companies and cheaper areas, whether that's in the US or indeed elsewhere globally. So I think it's important to retain a diversified approach geographically and by sector. And the tariffs specifically, again, we don't know where we're going to land here, but 60% tariffs, which have been flagged by Trump on Chinese imports, would very severely disrupt supply chains. I think they'd amplify risk aversion globally. China does account for around about 14% of US imports, and that's down reasonably materially over the last 4 or 5 years from more than 20%. So tariffs are probably going to be focused on strategic, or high tariffs are going to be focused on strategic areas like defense, technology, those areas taking priority. And if we were to see Chinese tariffs in aggregate, or tariffs on Chinese goods, I should say, average something closer to 20% than 60%, that's going to hit Chinese GDP maybe by 0.7%. I expect that the Chinese authorities would respond through a stimulus package, maybe weaken the currency, and that would offset to a great extent the direct impact of those tariffs. And it remains to be seen clearly what retaliatory action could be taken by China and other markets in the event that tariffs are imposed. So tech dominance, I think, probably persists. Deregulation could expose some of those large players to greater competition and scrutiny is another aspect of potential policy change. And I do think that the environment that we are likely to face in 2025, notwithstanding the premium valuation on US assets, favours the US market over other areas for the foreseeable future.